we are going to talk about asset classes. I'm a fund manager. I manage money in Indian equities. My views are biased because I've been doing this since I was very young, and this is something which we constantly evaluate when people come to us and say, I got this money, what should I do? So this has come from how we look at things, and this was very useful for everyone who is evaluating, who has got a bit of money, small money, lots of money, and investment discussions happen at home at the dinner table. And this will give you a perspective of how to look at things when you are in a decision-making role yourself, and when you will have your own money to invest, or you influence your parents when they are investing, making investment decisions. So this was something which I sat through Professor Bakshi's lecture, where he made us watch a movie. I don't know how many of you have seen this movie. It's called Vantage Point. Anybody watch this movie? It's a 2006 movie. I would recommend that you watch it. And there's an assassination of one of the leaders, and there are 8 people who are watching him give the speech. There's a reporter, there's a security guard, there's some tourists all over the place. Somebody's actually shot him, that person, and everybody's in a different place and they're looking at the same thing. And the investigation talks about how their perspective of what they saw from a different vantage point. So here we have a shoe. If I show 5 of you a shoe from a different angle, you all will all have a different perspective. If you see it on the side, in front, on the left, on the right, if you see the buckle, you can't see. In one of them, you can see. So for what is your vantage point when you're looking at something? Somebody may come up with a completely different perspective if they look at it from a different angle. So what is vantage point when you're looking at an asset class? So what is an asset class? So it's either land, or you buy shares, or you buy mutual funds, or some people trade in Bitcoin, somebody buys fixed deposits. So these are all different asset classes. Gold is an asset class. So whenever you evaluate an asset class, these are the criteria which you should evaluate it based on. First, volatility. How much do the prices fluctuate? 2, what kind of returns it can give? Whether if you keep your money in a bank, you'll make less money. If you buy shares, you may make more money. People see Bitcoin prices move 10–20% in a day. If somebody has Bitcoin, it's quite volatile, but the returns can be very high. Liquidity. Liquidity means today, say you have a bar of gold, and at 2 a.m. in the morning also, if you want to sell it, you can sell it. Today, if you have some shares, you log into your broking account on your phone, and you can sell it, the money will be in your account next day. Right? That's what liquidity means, how easy it is to buy or sell. If you have land, or if you have a house, it's quite tough to sell it. Buyer will come, there'll be negotiation. So it's not very liquid. If you have money in your bank, in your saving account, you can just swipe your debit card and the money, you can use the money. So it's very liquid. Second is the ease of investing. So today, if you want to buy a stock, you just log in, buy, sell. It's quite easy. You don't have to go somewhere, don't have to register, go to a registrar's office, pay some stamp duty, stand in a line, give lots of papers, make complicated documentation. Transaction costs. So if you buy or sell, let's say, an equity share, your transaction cost is virtually nil. If you buy real estate, there is stamp duty. In different states, there's different stamp duty. There's some 7% stamp duty. There's somewhere it's 10% stamp duty. You have to pay some brokerage to somebody. Regulatory framework. Now, in case of, say, a coin, which is regulatory framework, is not very clear. You know, who governs it? How do you store it? Does the Reserve Bank allow me to buy and sell it? What is the tax on it? So it's not very clear, the regulatory framework. Counterparty risk. What's counterparty risk? So counterparty risk means what is the value of the contract? So somebody says कि मुझे 5,000 रुपए चाहिए. I'll give it back to you next month. Now there's counterparty risk because you only have a promise in your hand, right? So there's no value of that contract because there's a private person has given you assurance that they will give you this money back. They'll say, okay, if you give me 5 grand, I'll give you 5.5 grand after 1 month. But even then there's counterparty risk because you're not sure whether you're going to get this money back. Whereas you open your 500 rupee note, it says, I promise to pay the bearer a sum of 500. That's what Reserve Bank of India says. So there's no counterparty risk. You go to a shop and give 500 rupees, they will honor it, right? That's what counterparty risk is. Then how are the present economic conditions which you will decide whether you should do A or B based on what is the current scenario? So let's take an example of your grandparents. So the time in which they grew up, okay, there was not much of, we were not independent, and it was reasonably oppressive economic conditions were there. So they would save all their money all the time, right? Inflation was high, prices would keep rising, people would buy land a lot. Now, 2 generations after that today, people are much more confident and they would like to spend their money. So they may not invest like how their grandparents would invest because they grew up in different times. So all these different vantage points. So if you sit down at home and talk to your parents and ask them about all this, then talk to your grandparents and ask them about this, and you ask yourself about this, you'll come up with all different kind of perspectives because the time in which the person who you're asking this question is giving you the answers is different. They grew up at a different time. So we'll go through the major asset classes one by one. So this is the first very simple one. You all may be familiar with this. Fixed income. You keep your money in the bank gives you some interest. You can buy government bonds, you can keep a fixed deposit in the bank, or you can lend money to companies. Again, when you lend money to companies, in brackets, there's credit risk. You may not get it back. But there are certain companies where people perceive them to be safe. Somebody say Birla is good, Tata is safe, Reliance may be safe. So somebody may say, no, my parents lost money, they invested in this company and they lost money. So corporate bonds have credit risk. Then there are debt mutual funds where you say, I don't know who to give money to, so I'll give it to a mutual fund, let them go and lend money to whoever they want. So what are the advantages of this? One, you get certainty of returns. You know how much you're going to get. They are safe. They are liquid as well, most of them. Like a provident fund account has to be kept for 15 years. But bonds are liquid. Bank fixed deposits are very liquid. You can go to the bank and say, I want my money back. Or when you log into your net banking app, you can say, I want to redeem my fixed deposit, and you'll get your money back in your account. You don't require any skill set, okay? Where you say, I don't know what I'm going to do. You just go to a bank, they'll give you 6-7% and you keep your money there. You don't have to evaluate anything. You didn't require some super skill sets. You get some tax benefits also if you buy government schemes. However, the last 2 points, the first one, it has relatively low, whenever you have certainty, you'll have low returns. So you don't get much. So if you get a fixed deposit in a bank and get 7%, you pay the government 30% tax, you'll get like 4.5–5% in your hand. It doesn't beat inflation. So whatever price rise happens in a year in India, traditionally the inflation has been more than 4–5%. So when you keep your money in the bank and have a fixed deposit, it doesn't beat inflation. Now this is what I do, okay? People give us a bunch of money and we invest it in the stock market. How can you invest in equity? Equity means you buy a share of a company. You get some part of the company you own. So even if you have 1 share, 5 shares, 10 shares, you own some part of the company. You can either buy listed companies, you can buy private companies, where somebody is starting a company, or you've heard the word startup, where somebody says, I want to raise money, will you invest? So people give them money and they give you shares in the company. You can buy exchange traded funds or you can buy mutual funds. All your objective should be that you should be buying shares in the stock market. Okay, all of you should do it. You guys are young, you have a lot of time on your hands. You'll be making money. If you don't make money right now, take some money from your parents. So what are the advantages of investing in the market? So equities have high returns. They give you some dividend. Companies grow, share prices move up. You can make more money with your capital. They're liquid. As I said, you can buy and sell them easily. So there's no sort of lock-in. You can kind of encash them whenever you want, sell by selling them. There's a strong regulatory framework in place. They have SEBI. So there's the Securities Exchange Board of India, which regulates the equity market. Today, when you download an app on the phone from your bank or from any other brokerage house, you don't think that it's unsafe. Okay, so the regulatory framework, today when you buy land, for example, it get encroached upon, somebody can break the fence, go inside, you go to the cops and say somebody is, encroached on your land. All this doesn't happen in the equity market. So when I joined the equity market, you had physical share certificates with your name written on it. You had to send it to the company when you sold them to get the other person's name on it who bought it from you. Many times the certificates used to be false, the signatures wouldn't match. All those things are in the past now. So there's a strong regulatory framework, there's a depository account, your shares come into them. It's very, very simple. You don't think twice. People can't run away. If you deal with regulated entities, they can't run away. As he said, there is SEBI, the Securities Exchange Board of India. You can't run away now. There's lots of publicly available data. I know you have a good library here, and there's lots of books on the equity investing in that library. There's a lot of publicly available data for you to make a decision. So when you buy land, people say, oh, it's there, it's next to my land, this road is going to come, that will happen, this will happen. But when you invest in equity, there's lots of data available. Companies are publishing their reports since 10, 20, 30 years. You can analyze them. You can compare them with the competitors. You can compare them with global companies. You can understand something if you want to. So there's lots of publicly available data when you want to invest in the equity market, which you can reasonably rely on. The transaction costs are very low, and it's the most democratic way of growing your capital. So when I say most democratic way of growing capital, it means if you have 1,000 rupees or you have 100 crores, it doesn't matter. Where you come from, what is your background, educational background, social background, which part of the country, world you've come from, it doesn't matter. All you need is a demat account and a broking account, and you can start off with even 100, 200, 500, 1,000 rupees. You have an opportunity to participate to grow your capital on your own. It is amongst all the asset classes where people invest their money, equities is the most democratic way of growing capital. And at a very young age, with a little bit of money, you can have a lot of capital in a few years' time. Over the long term, fluctuations in share prices are relatively low, okay? In the near term, of course, elections happen, geopolitical, there's war going on somewhere some election is going on, somewhere there is a banking crisis in some country. So stock prices move around a lot in the short term, but over the long term, the volatility seems very less. Okay, the last point, it requires skill, experience, and self-discipline. Okay, it's very, seductive, where you can sort of at a click of a button, you can do something, make some money, and it seems very speculative, and it requires a lot of self-discipline. Okay, how many of you have invested in the derivatives, futures, options? It requires a lot of self-discipline. It requires some level of skill, and it definitely requires experience, which you can get at a young age. And at this age, if you make some mistakes, like he said that he lost some money when he was trading derivatives. So Self-discipline, very important. This real estate, this is the biggest asset class in our country. So you can either buy residential real estate, commercial real estate, you can buy REITs which are listed on the stock exchange. So these are the advantages. The value of real estate. You know many of you would have heard, कि हमने 30-40 साल पहले ये ज़मीन खरीदी थी, and now one road has come from there, and now the price has appreciated. So it's a common thing for most of us. So it appreciates over time, the price of land. It is stable in value. It's also stable because you don't, like a stock, you can go out, see the stock price. After half an hour, you see the stock price. The prices keep moving up and down. You're tempted to do something. But nobody puts up, when you get up in the morning, you open your door, and outside your neighbor's house, his property value is written. Then you go down, you go for a jog, you come back up, now he's changed the value of his flat. So that doesn't happen, right? So it has stable value, or at least perceived stability is there. If you rent it out, you get rental income, bhada milta hai. Okay? There's a social status associated with owning land, where people think that, oh, iske paas itni zameen hai. And this has partly come from our earlier, where the British kept control on the land. There was a zamindari system where people all used to work for the zamindar. So this is a historical reason as to why social status is there associated with, abhi uske paas itne flat hai, yahan bhi ghar hai, wahan bhi ghar hai, and people are like, oh wow, this person must be doing well because there's so much of land. However, with this baggage of advantages, it comes with a lot of disadvantages as well. It's illiquid, you can't sell it. Okay, try selling land, especially ancestral land, it's very, very tough. You don't get the value what it is worth. Asset rich, cash poor. Okay. So I've heard now my uncle stays in South Bombay. Okay, he stays in Malabar Hill. Okay, and we stay in Pune. So when our ancestral house got sold, he got a house in Bombay and we bought a house in Pune, right? So today, he's no more now, but from when I was a child and I used to go and meet him, he would always tell me, why did your father buy a house in Pune and not when he had an opportunity to buy a house in Malabar Hill? So, but however, if he had to write out a check of X amount, he didn't have that money in his bank. But he had a big house in Malabar Hill, but he was asset rich. He'd always say, my house is worth so much, your father made a mistake, I really don't know why he bought this house in Pune. But he's cash poor. Today, if he has to write out a large check, 50 lakhs, 1, 2, 5 crore, he never had money. But his house was worth a lot of money. So when you have real estate, sometimes you're asset rich but cash poor. It of course requires ongoing physical management and costs where you have to keep maintaining your properties if they're in different cities. Say you finish from Flame today and you get a job in Bangalore. You work there for 5-7 years. You bought a house. Then you move to Delhi and you stay there now. Now twice a year you have to go to Bangalore and check what's happening in your house. Whether a tenant will call up and say, oh, the pipe is leaking and the paint is bad. So this requires a lot of ongoing physical management. There's a concentration risk. Concentration risk means all your eggs are in that basket because it requires a lot of money. Today you buy a house in say in a big city in India, in say the top 5-7 cities, it'll at least cost 2-3 crore rupees. So you put in a lot of money in one asset. It has high transaction costs, brokerage, stamp duty, taxes. These are very high in real estate. And there are legal complications also. Let's say you have some 100 acres of land in a village somewhere your family has. When you have land, suddenly you discover when you go to sell it, there are other 10 people who own the land with you. Land records in India are not yet digitized. Okay, this is an old problem. So a lot of legal complications can happen when you own real estate. Gold. So in India, there is in the East, actually not only in India, even in China, there is people don't trust the Raja or the king always, or the government, whatever you want to call it. So people in historical times, because people buy gold because the paper money keeps devaluing. So today, if you took a 10 rupee note, it says, I promise to pay the bearer rupees 10, right? It doesn't say what you can buy with this 10 rupees. So probably 10 rupees will not get you a vada pav today. It could probably get you 5 vada pavs 20 years ago, 25 years ago. So the value of paper money has always gone down. So people have put their faith in gold for centuries now. You can't make it in a lab, unlike diamonds, which you can make in a lab. Gold alchemists have tried for centuries and they have not been successful. So physical gold always preserves your purchasing power. So let's say you had 1,000 rupees 20 years ago, and you could buy, somebody said, I'll keep 1,000 rupees with me, and somebody said, I'll buy 1,000 rupees worth of gold. Today, after 20 years, that 1,000 rupees can probably buy what you could buy with 1,000 bucks. It'll require probably 5-6 grand to buy the 1,000 rupees worth of things which you had 20 years ago. But with the 1,000 rupees worth of gold, if you sold it, you could probably buy those things today also. So gold preserves your purchasing power. You can buy gold in many forms. You can buy physical gold, sovereign gold bonds. You can buy gold ETFs. I may have to do a whole day session to explain each of these. It's an insurance against the paper money system and in crisis. If you read financial history, so the Romans, okay, they had earlier gold coins. Then they fought a lot of wars. There was no gold. Then they made it half gold, half silver. Then they made it only silver. Then silver and bronze, half silver, half bronze, then bronze, then copper, and then it becomes metal only. So now we have paper money. So when governments print money to fund their deficits, they keep borrowing more and more money and devaluing your paper money. So gold is a hedge against all that. It's highly liquid. You can sell it anytime. You require no skill to buy a bar of gold. You just make sure it's hallmarked, it's genuine, you can buy it. Now you can buy it in non-physical also. There are traded options. Gold ETFs are there which you can trade in the market, which you can buy through your brokerage accounts, where the mutual fund will go and buy the gold. You don't have to worry about storing it and all those kind of things. Now the disadvantage is it does not generate income. You don't get money. The gold is just locked away in your cupboard. It requires costly storage. If you have lots of gold, it will get stolen, so you have to store it and you pay for the storage. There's geopolitical risk. If people hold in the 40s, when the Bretton Woods conference, the American government confiscated physical gold held by its citizens. This is art. Some people know how to buy it. So you can buy it in the ETF form. So some people buy paintings. You should know how to do it. If the painting that you bought, the artist becomes famous, the painting will increase in value. It appreciates a lot over the long term. The original is only one. Okay, of course, you can buy prints. They are not so valuable as the originals. But this is a highly skilled job. Okay, it requires an eye to identify, newer artists which will become famous. It's illiquid. You can't sell it. You need people. Like-minded people will only buy it. Participation is an exclusive club. So, if you see the con here, participation in exclusive clubs is restricted. You won't be invited to some big auction where Sotheby is going to sell some big painting for a few $1 million. Even if you have the money, nobody is going to call you. They may call you if you're a famous person. It's an exclusive club. You can't gain entry into it. Data is not available. There's no database where you can Google, you can sort of search, what paintings, what happened 100 years, in 100 years, how many transactions. Many of these transactions are very private, so you won't come to know. Cryptocurrencies has been talked a lot about in the last 5 years. High returns, prices fluctuate a lot. They become half over a few days, then suddenly go double. This is an evolving regulatory framework. The rules around all this are not the same across the country, across the world. There's counterparty risk. Where do you keep your coins? Sometimes the exchanges go bust. Where your money is going, you don't know. The brokers are not part of a organized, like he said, there is SEBI. So there is no proper regulator for this asset class. So as we saw, there were vantage points. This is a summary of each and every asset class based on risk, returns, and liquidity. So you look at gold. It's got low risk, which is green. It doesn't give you high returns, it gives you moderate returns, but it's very high in liquidity. You can sell it anytime. So if you look at land, it has moderate risk, high returns, but no liquidity. It's in red. So green is the best, moderate, and then red. This is how you rank all the asset class. So if you look at fixed deposits, green, low risk, low returns, high liquidity. Stocks, high risk, can give you high returns, and high liquidity. You must have this table with you when you are evaluating asset classes. These are the basic characteristics of all asset classes. So this is just some Excel working which we did. If in 1990 you put 100 rupees in a fixed deposit, it's 1161 today after 33 years. If you bought the government bond from the government of India, it's 1231 rupees. If you bought just the Sensex, which is the BSE exchange index, it's 8.5 times. It's from 100 to 8,500. If you bought gold, its 100 has become 1856. So gold has protected your inflation against inflation, whereas the index, the equity market, has given you very high returns. So here you can see this. If you look at the fixed deposit in the financial assets, low risk, low returns, high liquidity. So the returns are in the red. If you look at gold, the returns are in the moderate, which is here, 1856. If you look at the equities, the returns are high, where it's substantially higher than the other investment opportunity assets. So then now we just come to the last concept is asset allocation. So asset allocation means you choose the asset class and out of all these, and you come up with a mixture, choose a percentage of each based on your own condition or situation or economic situation in life. The idea is that this perfect mixture should give you an optimum return on your money. So let's look at this. This is something which is correlation. So if one goes, so let's say you want to slap somebody, okay, you hit somebody, what is the correlation? How will that person react if you do this? I mean, the outcome is obvious, but they may cry, they may hit you back, they may run away from there, I don't know, right? So if you buy bonds in India and you have only bonds, your correlation is with India debt, that's all. The second portfolio, if you look at Indian equities, are not correlated with Indian bonds. Bonds appreciate in value because of the interest. It doesn't have any effect on the stock market. Or if the stock market is going up, the bond is not concerned about it. So there's no correlation between Indian equities and Indian bonds. Now I'm putting gold in it. Now I have three assets. So gold is not connected with Indian debt, equities are not connected with gold, and gold is obviously correlated with the gold. Now I am putting a fourth part of it, which is international equities, and you can see Indian equities are somewhat correlated with international equities, but the other assets are not. Okay? We've taken this from DSP Mutual Fund. This is from their presentation. Let's say I only bought shares from the last 23 years. I've got a return of 12.8%. If I only bought bonds, debt, I've got a return of 7.5%. Because each year, if you look at 2000, the stock market fell by 20%, Indian. The international This is a table on the top left. International equity fell by 8%. The gold price went up by 1%. And the bonds went up by 10%. So if in each year, I bought the thing which went up the most and I didn't have the thing which went down the most, I would make the green skyscraper here, which is a return of 28.7%. But that's only theoretical because I can do this in the past. I can't do this prospectively. So if I look at the last green skyscraper, if I had equal amount of money invested in all of them, I'd make 11%. That's better than making 12.8% in stocks. So it shows us if we are diversified, the fluctuation in our returns is going to be quite low. If you look at the big skyscraper there, that's the perfect one. But you can only do that in post-mortem. You can't do it prospectively. So that's only theoretical. But I say I put money in everything. If I put money in everything, I got 11% for the last 23 years. It's better than putting money only in domestic shares because that's only one exposure to only one thing. Okay, so this is how. So let's start from the top right hand corner. Low correlation. Now, Indian bond prices and stock prices are not correlated. So if I have low correlation, I'll have more assets, high diversification. I'll have low risk because I have put my money in many places. I'll get low returns. However, versus high correlation, high concentration. Let's say I only bought Bitcoin when it was $5. I didn't do anything else. Today it's worth $65,000, right? So there's high correlation, high concentration, high risk, high return potential. So if you understand something really well and you bet the house on it, you can get high returns. However, the possibility of an accident is also there. So diversification protects downside, concentration creates upside. So right balance is the key. On the left, you have what is your capacity to understand a particular asset? What is your capability to invest in it? Do you have money? Do you don't have money? What is your perspective now? What do you think is going to happen with this? And what is your preference? You make this table. Whatever ticks the maximum for you, you need to invest more time in understanding that, and that's how you decide what works for you and not. So if I look at artifacts, most people will not, it will not get ticked for most people, any of it won't happen. So this is the table which you need to keep in front of you when you're evaluating something. Do you understand this? Yes. If you understand it. But do you have the money to buy land? No. Then that's a cross mark for you. So it doesn't matter what your perspective and your preference is. If you have no capability, you can't understand, you can't do that.